to the Overberg Asset Management Market Review. In this episode, Nick and Hilly shares with us the highlights of the markets, both globally and in South Africa. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day and welcome. I am Nick from the Overberg Greater Office. We are glad that you can join us. Today we are looking at the developments globally, if there have been any changes and how they might influence the markets. All right, everyone, welcome. So in the talk this morning, I'm going to start off with the bearish news first, which is going to involve cross-border capital. Michael Howell is quite dramatic at the best of times. So anyway, we'll start off with the bad news and then more moderate, and then finishing off with the more bullish news and outlooks, which I think is probably where our view currently falls. Then we're going to talk a little bit about China, how it relates to liquidity and liquidity squeeze that's going on in China. Finally, a couple of interesting observations about the value versus growth style of investing and how well each one is doing versus the other at the moment. So then, starting off with the bearish news, it's cross-border capital. Risk assets are definitively in bear markets and likely to suffer the 30% drop stemming from liquidity tightening plus recession that we have been warning about for some months. Now, of course, don't forget that the S&P has already dropped 16%. Global growth stocks already dropped about 27%. So we're probably 2/3 of the way through that drop already. The US Fed is targeting lower inflation through demand and wealth destruction, and the knock-on implications of dollar scarcity for international currency markets look certain to unsettle emerging markets, notably China. And then just a word about the Fed. So the Federal Reserve's balance sheet is now 3 times bigger than where it was after the 2008-2009 global financial crisis. So it's got a lot of power. When the Fed does something, it's always going to move the needle on the markets. But of course now, particularly having such a large balance sheet, then its effect could be amplified. A word on bond markets, so often a key signpost, have suffered a terrible 6 months. A whopping rise in yields of this scale often leads on to greater equity market volatility 12 to 18 months later. Volatility is likely to step up. Moreover, as capital is sucked back to the US and global liquidity falters, emerging markets will suffer badly. And then he talks about bear market rallies, and often bear market rallies are very exciting, very enticing. He cites the example in technology stocks after the Y2K sell-off in 2001. The Nasdaq dropped by 78%, peak to trough, but over that period the index enjoyed 15 daily rallies, each exceeded 10%. So watch out for those bear market rallies. So a slightly more circumspect view from capital economics. Although we suspect that inflation in the US has now peaked, we don't think that this will prevent either long-dated Treasury yields from rising again or the stock market from coming under renewed pressure until the middle of next year. Fortunes won't turn around decisively until shortly before the Fed stops tightening policy in summer 2023. Even if the central bank manages to engineer a soft landing. But they do stress that they do not believe there will be a big blowout in equity markets. Now for the good news from capital economics. Once the Fed's finished tightening, or even when it's close to tightening, by the middle of 2023, we can expect really very decent gains from global equities because of much lower valuations. So the annualized returns, so in both 2023 and 2024, for the global market, 10.8%, developed markets in Europe, 8.2%, developed markets in the Pacific, 19.9 annualized. This is EMEA, emerging markets, 8.8, emerging markets Asia, 8.8. So really very bullish. And really, we're almost there. It's only 12 months to go. So they project the 10-year Treasury yield will rise further to around 3.8% in the middle of next year before dropping back to 3.2% by the end of 2023 and 2.7% by the end of 2024. They do, however, expect commodity prices to falter, dropping probably -8% this year, and again negative readings in 2023 and 2024. Premised on the view that China's economy will remain weak due to poor policy-making decisions. So some investors don't have that patience to wait for 12 months. We know that Warren Buffett has been buying furiously in the markets, and even bank credit analyst research, they've just upgraded global equities to overweight, taking advantage of the cheaper valuations. And I suppose there's a lot of merit in that view. If equities are only going to drop a little bit and we're already 2/3 or 3/4 through the decline, then why take the risk? So BCA, and quite a lot of what BCA were writing was covered in the weekly report yesterday. Quite a few of the conditions leading to the decline in equity markets we're actually beginning to ease. COVID outbreaks, peaking in inflation, the war in Ukraine maybe not being quite as bad in terms of spreading globally as some may have thought. Inflation expectations should come down as goods inflation recedes and oil prices come off their highs. The chief commodity strategist from BCA sees the price of Brent averaging $86 per barrel in the second half of this year, down 16% from current levels. Central banks will dial back their hawkishness, with inflation set to fall over the remainder of the year and financial markets showing increasing signs of stress. The Fed and other central banks will adopt the softer tone. So that global liquidity contraction that Michael Howell is talking about may not actually transpire. And even MRB, which is very, very negative in terms of its inflation outlook, offers some reprieve in terms of the inflation over at least the short to medium term. Potential upcoming good news for global financial markets will be a short-term easing in US inflation, which in turn will allow deeply oversold bond markets to finally calm. Moving on to China, I'm afraid it's not good news, but at least we have now, I think, completely sold out the Fidelity China special situations. The title of the cross-border capital report, China on the brink, under attack from a weaponized US dollar. Renewed monetary tightening by the PBOC, the China's People's Bank of China, due to their desire to maintain a stable yuan, and this appears to be driving policy. Currencies matter hugely. Our long-standing rule about emerging markets is that every EM crisis is first and foremost a currency crisis. So weaponization, what he means there is the very strong appreciation in the dollar versus global currencies. Currency volatility spiked by a factor of 3 in April, most visibly in terms of the yen and the yuan. Indeed, China may already be in a technical recession. Let's look at value stocks, which are already doing very well. The relevance to this to our global portfolios is that we are half in value, half in growth, but most of the selling that's taken place in order to increase cash in the portfolios has been to reduce exposure to the growth cohort within the models. The MSCI World Value Index has dropped in 2022 by around 7%. The MSCI World Growth Index, on the other hand, has dropped by 25% year to date. This is an article from the Financial Times. Investment firm AQR looks at the dispersion value spread between growth and value stocks. Even though there's been a re-rating of value versus growth, the spread is still stretched on a historic basis and actually is as wide as it was at the peak of the dot-com bubble in 2000, which means the value outperformance still has some way to go. In fact, they predict it'll carry on for the next 3 years. Vanguard predicts US value stocks will outperform growth in the US over the next 10 years by 4%.
Thank you, Nick. As you all know, I am Gili, and I'm also based in the Overberg Greyton office. On the local side, it's news from Raubex. It's non-financial news, but it's nevertheless important. Raubex has announced that Rudolf Houry, the CEO, will retire effectively the 31st of July. He has been with the company for 25 years. Felicia Maziza, currently an executive director, has been appointed as the new CEO of Raubex, effective from the 1st of August. She joined Raubex in 2011 as an independent director, and previously she has been with Denel and City Power, which may be not good news, but she has been trained and coached and mentored by Rudolf Houry for the past 5 years, and he is confident and sure that she is fit and capable to become the first female CEO of a JSE-listed construction company. And then Raubex, also the financial news, their results for the 2022 years are out. The headline earnings per share is up, listen carefully, is up 263%. Revenue increased by 31% to 11 billion rand. It's the first time that they are going over 10 billion rand. It was a good set of statements. And the order book is even better. The order book stands at 17 billion rand. So that's more orders for 1 full year. They can carry on for 1 year with those orders. Dis-Chem, a bit of bad news with Dis-Chem. They had a major data hack affecting 3.6 million of their clients. MTN, they released quarterly update for the 3 months till the end of 31st of March. And the group EBITDA advanced with 21.1%. Excellent figures. Anglo American announced that the value of rough diamond sales for De Beers, this was the 4th cycle of the year, amounted to $604 million. Cycle 3 was less, it was $566 million. And net foreign buying and selling, there's net foreign selling year to date, 2 billion rand.
Fantastic, thank you, Gili.